If you've been following the stock market over the past few weeks, you've probably seen something unusual, something which confused new investors and excited experienced ones. Some of the strongest companies in the AI and semiconductor space, companies that have delivered record-breaking growth for multiple quarters in a row, suddenly began dropping. It started with Nvidia sell-off after a fantastic earnings. AMD slipped. Palantir sold off. Even companies indirectly tied to AI, like cloud providers, large-cap tech, and data center suppliers, suddenly pulled back. Whenever this happens, headlines start screaming about bubbles, reversals, crashes, and the end of AI hype. But reality is almost never that dramatic. In fact, if you zoom out and view the situation through data, not emotions, this pullback is exactly the kind of setup long-term investors wait for. Historically, the biggest wealth-building moments in the stock market didn't happen when prices were soaring. They happened when fear forced prices far below the true value of the business. So today, we're breaking down why the AI market suddenly fell, what the hard numbers actually show, how to know when fear is peaking, and most importantly, which companies are shaping up to be massive long-term winners in the next decade of AI and cloud computing. Let's start with the spark that ignited the sell-off. The first trigger came from one of the most famous names in investing, Michael Burry. Even though his one big prediction was nearly 2 decades ago, his reputation for calling the 2008 housing crash still influences markets today. That's why, when his fund revealed enormous short positions, nearly $900 million against Palantir and about $200 million against Nvidia, the market instantly reacted. That's over $1 billion betting against 2 of the most dominant AI companies today. And because these positions represented around 80% of his disclosed portfolio, the headlines practically wrote themselves: Burry bets against AI, Burry predicts crash, Burry shorting Nvidia, is the bubble popping? But headlines rarely tell the full story. Short positions are tactical, not philosophical. Burry isn't predicting the collapse of AI. He's betting those stocks ran up too quickly and that a pullback was likely in the short term. That's it. But because of his influence, retail investors panicked, algorithms accelerated the selling, and fear spread faster than logic. We've seen the same pattern before. One influential voice creates a psychological chain reaction. And then came the second shock, one that actually matters far more to the broader market. The University of Michigan Consumer Sentiment Index, a widely respected indicator for understanding how Americans feel about their personal finances and the broader economy, fell to around 52, one of its lowest readings in nearly 20 years. To put that into context, 100 is neutral and below 60 is recession-level fear. A reading around 52 is extremely low by historical standards. It reflects deep consumer pessimism, not just about the economy today, but about the future. Why does this matter? Because when consumers feel nervous, they would tend to spend less, save more, delay purchases and basically repair family balance sheet. While this is probably good for individual families, that slows down business revenue and the whole economy. Companies' earnings become lower, which feeds directly into stock valuations and stock prices. None of this had anything to do with Nvidia's performance, or Palantir's contracts, or AMD's product roadmap. It was simply a wave of fear across the entire economy, and AI stocks fell because fear pushes capital away from risk and into safety. So you have 2 strong fear catalysts combining, Burry's billion-dollar shorts and consumer sentiment collapsing to decade lows. When those collide, even strong companies get dragged down. But this is where smart investors start paying attention. Because fear does something extraordinarily important, it disconnects price from value. Everyone says, buy the dip, but buying intelligently requires knowing when the dip represents genuine opportunity, and when it's just the beginning of something deeper. That's where data becomes your advantage, and that is what we are sharing here. There are 2 indicators I rely on more than anything else, the CNN Fear and Greed Index and the VIX Volatility Index. These 2 together form one of the most accurate fear detection systems in modern investing. The Fear and Greed Index aggregates 7 indicators, namely, stock price strength, trading volume, put-to-call ratios, volatility levels, safe haven demand, junk bond spread behavior and market momentum. the result is a single number on a scale from 0 to 100, where 0 is extreme fear and 100 is extreme greed. Right now, the index is already flashing fear and dipping into extreme fear on and off. But historically, the most powerful long-term buying windows occur when fear stays extreme for multiple days, momentum drops far below the 6-month average, and selling accelerates faster than volume usually justifies. This cocktail of conditions often precedes major reversals. The second indicator is the VIX, which is the market's panic meter. The VIX measures expected volatility of the S&P 500. It doesn't just show fear, it shows how fast fear is rising. Here's how to read it. A value of 15 to 19 means calm, which 30 to 40 means panic, and a reading above 40 means capitulation. The last major market bottom happened on a day when the VIX surged above 30, and the S&P 500 bottomed the same day. Today, the VIX hasn't reached full panic yet, but it's climbing. And that's exactly why investors should be preparing, not rushing, not panicking, but preparing for a potentially exceptional entry point. What should investors actually do? It comes down to two simple principles. Principle 1. Keep your long-term dollar cost averaging steady. Stopping contributions during downturns is one of the most damaging mistakes long-term investors make. DCA is designed to buy more shares when prices fall, exactly when fear is at its highest. Principle 2. Build cash reserves for when fear peaks. You don't have to time the exact bottom to benefit. But you do want dry powder ready for moments when the fear and greed index is near zero, the VIX spikes into the 30s, market momentum hits multi-month lows, and the selling pressure becomes irrational. Those moments rarely last long, sometimes only a few days. But they often present some of the best opportunities of an entire decade. When we talk about long-term investments that can power through downturns and come out stronger, 3 companies stand out more than almost any others. Stock number 1 is Amazon. Amazon sits at the intersection of nearly every major economic trend shaping the next decade, like e-commerce, logistics, cloud computing, AI infrastructure, and digital advertising. Even though most people think of Amazon as a retail company, AWS is the true profit engine, and it's becoming increasingly essential for AI model training, inference, and enterprise AI workloads. DCF models currently indicate Amazon is undervalued by around 17%, but I believe this underestimates the company's true optionality. Why? Because Amazon's advertising segment, something many people still forget exists, is now the 3rd largest ad platform in the world, behind only Google and Meta. Advertising has far higher margins than e-commerce. That means Amazon is transitioning into a hybrid, part AI cloud provider, part logistics empire, and part global advertising giant. That's an incredible combination. When consumer sentiment rebounds, Amazon's retail business strengthens. When AI spending accelerates, AWS strengthens. When cloud-delivered ads expand, the advertising segment strengthens. There are very few global companies with this much leverage in multiple trillion-dollar markets. Stock number 2 is Meta. Meta is one of the most consistently underestimated companies in the world. Yes, Meta spends billions on AI, but that spending is strategic. It's required. Meta has 3.5 billion monthly active users. No other company on earth distributes content to that many people with that much personalization. To power that, Meta needs enormous compute clusters, enormous data pipelines, and enormous AI models. And here's the key insight most investors miss: every improvement in Meta's AI recommendation systems increases user engagement, which increases ad impressions, which increases ad revenue, which increases profit exponentially. This is why Meta invests so aggressively into infrastructure. It's not optional, it's a revenue multiplier. DCF models suggest Meta could be 45% undervalued, with possible upside approaching 80% over the coming cycle. Meta is no longer just a social media company. It is rapidly becoming one of the world's largest, most sophisticated AI companies, and a critical infrastructure provider for the advertising ecosystem. And the last name is Alphabet. Google is one of the most misunderstood AI companies, but also one of the most important. While the media likes to say Google is behind in AI because OpenAI and Anthropic grabbed early headlines, the reality is completely different. Google owns the world's largest search engine, the largest online advertising network, one of the largest cloud computing platforms, YouTube, the world's biggest video platform, Android, the most widely used operating system worldwide, and Gmail, Maps, Photos, Chrome, Google Workspace, and more. Every single one of these products is being upgraded with AI, and every upgrade increases stickiness, engagement, and monetization potential. And let's not forget Google invented the transformer, the architecture that powers almost every modern AI model. Google also builds its own AI chips, TPUs, which are used by some of the largest model developers in the world. Alphabet is diversified across search, ads, AI research, cloud, hardware, software, and enterprise productivity. Very few companies have this level of durability, revenue diversity, and global reach. DCF models suggest Alphabet is undervalued by 20 to 25%, and long-term, the company is positioned to be one of the dominant AI-era global platforms. When you step back from the short-term noise and look at the fundamentals, a very clear picture emerges. AI demand is still rising, cloud spending is accelerating, enterprise AI adoption is in the early innings, and the sell-off was caused by fear, not fundamentals. This is the moment when patient investors prepare. Because fear always feels uncomfortable in the moment, but in hindsight, it always looks like opportunity. Amazon, Meta, and Alphabet are not speculative bets. They are foundational companies in the global AI, cloud, and advertising economy. They have diversified revenue streams, massive research budgets, durable moats, and enormous global user bases. And when sentiment reverses, as it always does, these companies are positioned not only to recover, but to lead the next decade of market growth. The question is not whether AI continues. The question is whether investors have the discipline to buy when fear is loudest. For those who do, downturns like this are not threats, they are gifts.